and welcome to Market Domination. I'm Julie Hyman. That's Josh Lipton, live from our New York City headquarters. We are giving you the ultimate investing playbook to help tune out the noise and make the right moves for your money.
And here's your headline blitz, getting you up to speed 1 hour before the closing bell rings on Wall Street.
January is always a bit higher. Our expectation was it would become higher than consensus. Nowhere near where this print is, but we still feel over the course of the year, things like, OER will trend lower. I mean, you could have, a couple of dents in disinflation, but we don't think it's going to be completely derailed.
We're looking for several months, and we're back in the case of last year where we're going to have to see months and months getting out of the first quarter of better inflation data before the Fed gets comfortable with it. So that really does push the timeline probably into the second half of the year if things go well, right? If this ends up being the outlier.
You can control your party, GOP, you can control Congress, you can control the judges, you can control the Supreme Court, you can control even the media because you're controlling X, but you cannot control the investors. And the investors are going to punish you if your policies are bad for growth and increase inflation. So I think that's going to be the most powerful constraint.
We got 1 hour to go until the market close. We're taking a look at the major averages, which continue to digest this morning's hotter than estimated CPI report, both on the headline and on the core level. So we saw a dip for stocks, but most of the major averages are coming back at least from their lowest levels of the session, at the least, or even in the case of the Nasdaq, are now in the positive. The Dow still off by about 202 points, down about 0.5%, but the S&P only off about 1/5%. And as you can see, is sort of come off the lows throughout the course of the session. The Nasdaq's now higher by 0.2%, Josh.
Yeah, it was an unwelcome acceleration. That is how I heard one economist.
Like that.
Yeah, nice, right? That's how one economist expressed it to his clients on the CPI print. I mean, we have had economists on this show, Julie, who have expressed their worry, and we've heard about underlying inflation and these concerns about whether we could be sort of just stuck in this range. And so to your point, I think investors trying to digest that, make sense of this. Is that true? What are the kind of read-throughs of the Fed today? You've seen a lot of research notes being passed around. Could the Fed be done cutting this year? And even on this print, does it change the chances or probabilities you give to even a hike in 2020?
Right. I think Bank of America's Aditya Bave and his team today said it is not inconceivable to see a hike this year. Let's talk about some of the other assets and seeing how all this is playing out. We've got the 10-year rising today. Now, unlike stocks, the 10-year rose in response to the report and stayed there, right? We're not seeing that kind of gyration. So we'll talk throughout the show about the equity reaction that we've been seeing. The dollar, as we saw it today, did have some gyration, so to speak. Now is very little changed. I also want to point out what we're seeing in crude oil. President Trump has said that he's going to be getting on the phone with Vladimir Putin of Russia to try to figure out some sort of resolution to the war with Ukraine.
Trump saying basically he agreed with Putin that it was time to start talking about an end to that war.
Right, and so it looks like maybe there are some implications for supply in the oil market. We see oil prices down a bit today. That could be one of the things going on. And then I want to also point out on an individual stock basis, seeing some interesting moves. Meta.
Keep trucking.
It's still going up. I mean, this is incredible at this point. What do we have here? We have only the 16-day chart. I guess we look at the 1 month chart there. We can see going for 18 straight days higher for Meta, which is pretty incredible. And then on the flip side, we have Tesla reversing some of the recent declines it's had with a little bit of upside today. Today up about 5%. There was an analyst at Benchmark that initiated coverage of Tesla with the buy rating.
Yes.
Exactly. We're going to talk about that later in the show, but that's another one that stands out today.
We will. All right, Julie. Fed Chair Jay Powell returned to Capitol Hill today to continue his testimony before Congress. Joining us now is Yahoo Finance's Jennifer Schonberger. Jen.
Good afternoon, Josh. Indeed, he did. And Fed Chair Jay Powell reinforced the Fed's cautious stance again today in the second day of his semi-annual congressional testimony, where he reiterated to House lawmakers that the Fed is not in a hurry to change its stance on interest rates. In response to this morning's hotter than expected January CPI report, Powell stressed that the central bank wants to remain restrictive for now.
I would say we're close, but not there on inflation. And you did see today's inflation print, which says the same thing. I mean, we've made great progress toward 2%. Last year, inflation was 2.6%. So great progress, but we're not quite there yet. So we want to keep policy restrictive.
Republicans asked Chair Powell about regulation to rules-based monetary policy. At one point, Chair Powell was asked by Representative Huizenga whether a vice chair of supervision was really needed. Powell said for many years, the Fed did its oversight without a vice chair of supervision and that it was effective and actually less volatile. Democrats honed in on Fed independence to tariffs, Elon Musk, and the CFPB.
When Musk comes knocking at the Fed's door, are you going to let him in?
I don't have anything for you on that.
Would you like to tell us today that you won't let Doge into the Federal Reserve or have access to the systems and the data?
So I don't have any, we've had no contact, and I don't really have, I have nothing for you to report today on that.
And Powell repeatedly again reserved judgment on the impact of President Trump's tariffs on the economy and monetary policy. Guys?
Thank you, Jen. Inflation surpassing Wall Street as it rises more than expected, seeing the largest monthly headline increase since August 2023. Fed Chair Jerome Powell saying in an appearance before House lawmakers that we're close, but not there on inflation. Markets now seeing the pace of Fed rate cuts slowing down in 2025. For more on the ripple effects, let's get to Interactive Brokers senior economist Jose Torres. Jose, great to see you as always. So that CPI print, it does top forecasts. Did it top your forecast, Jose?
Absolutely.
Were you surprised by what you saw?
It was a crazy surprise. It was ridiculous. 0.5% month over month, folks, that annualizes to 6%. Of course, just 1 month. But the first month of the new administration coming in, what a way to get started, right? You have also inflationary risk going forward on the tariff front. Could goods begin to reinflate? We saw used automobiles lead the way, right? Are folks front running the possibility that tariffs and restrictions later can increase those prices? Is that filtering into expectations, right? Then also on the immigration front, we saw in the jobs report, wage pressures really lofty. We're probably going to see certainly going to see labor force growth decelerate with the immigration restrictions. So we have some pressure there to the upside on wages. However, that could be countered by shelter, right? With the immigration restriction, we could have an incremental increase in the vacancy rate that can soften rents, soften home price appreciation. So, those are some countering effects. Also, drill, baby, drill, higher oil production. Maybe we get West Texas Intermediate in the 60s, maybe the high 50s. Those are some countering effects in terms of what can go right. But right now, the economy is really strong. Consumer spending is buoyant. Labor markets are tight. Subdued unemployment, rising paycheck growth. So it's not an environment that's necessarily conducive for lower inflation.
I want to ask about something that we've all been talking about a lot, and that's egg inflation. And I know that this is not part of what the Fed looks at. I know it's because of avian flu, but Michael McDonough over at Bloomberg put together what he calls the bacon, egg, and cheese plus coffee index. And now if you prepare this meal, this breakfast for yourself at home, on average it costs you $3.03, which is a big increase even month over month and year over year. And again, even though it doesn't go into the Fed's calculation, how do everyday things like this affect inflation expectations, which can feed into core inflation, right? I mean, is that how we should think about it?
Partially, and really weighs on consumer sentiment. We've been seeing those confidence numbers begin to get depressed. Folks, they have sticker shock. They go to the store and they can't believe that a carton of 12 eggs costs $12, $1 an egg in some cases.
Yes, an anecdotal report from here in the Yahoo Finance newsroom. In fact, $12 for
yes,
a carton of
I mean,
eggs.
I even heard folks, Julie, Josh, I heard folks out there talking about how can we start laying eggs so we can benefit ourselves, right? Because they're so expensive. But all jokes aside and keeping it more serious, they absolutely do filter into expectations of the consumer, and then that also works themselves into businesses. Now, one important fact, September last year, the Fed rushed that 50 basis point cut, right? That essentially pigeonholed them to, you can't go from a 50 basis point cut to then not cutting the next meeting.
Was that a mistake, Jose?
It was absolutely a mistake. Then they had to go a quarter point in November, a quarter point in December, because how can you cut 50 and the next meeting go down to 0, right? So that was pivotal. Can you believe, is it a coincidence that CPI bottomed that same month in September at 2.4%? Now we're at 3%. I expect economic growth to accelerate, driven by trade acquiescence, lighter taxation, milder regulatory regime, and a manufacturing onshoring push, right? So all those things happening, can inflation really come down? I think inflation stays right around 3%. There's a risk though, folks. Julie, Josh, if inflation moves up to 3.5%, what Jennifer was talking about earlier, the Fed may have to turn around and start hiking.
What's the chances of that? Is that if you were to look at it, if you were to gauge the chances, the probabilities that actually it's a hike in 2025, what would you put that at?
You know, Josh, it's not that low. Right now, I'm going to say 25%.
Wow.
25% chance. All right, let's talk about some of the other inputs. Some of them you mentioned, but you talked about tariffs as being a potential pressure here. We've been watching the auto industry very closely here. So if you looked at things like motor vehicle maintenance and repair in the CPI report, you looked at, I mean, new vehicle prices actually came down a little bit month over month, but used vehicles still rising. How worried are you about that particular area and the tariff effect?
I'm hoping that the tariffs are more of a negotiation tactic, right? Trying to get some political wins, trying to gather the allies.
But sorry to push back on that, but with Mexico and Canada, fine, that's already been delayed. But it seems like the steel and aluminum ones are not necessarily negotiating tactics. What about this view that some of them are not negotiating tactics, they're just economic tariffs put in place for various reasons, for either competitive advantage in the U.S. or to get revenue to offset a tax cut? Well,
in that assumption, if a lot of those tariffs remain, those 25% tariffs, then those are inflationary. Those are inherently inflationary. And that 3.5% CPI case that would lead to that hike does open up significantly. So if you believe that we're going to maintain high degree of tariffs for the medium term, call it 3 months or more, then absolutely those are inflationary. President Trump has spoken about short-term pain necessary to achieve economic wins in the medium and long term. Bring some more of those manufacturing jobs. We used to have roughly 20 million. Today we have around 11 million. Maybe we get 3 or 4 million of those back, right, over time. So he has spoken about, taking the short-term pain for the medium-term gain. I'm hoping this is more of a strategy to keep the Western Bloc and the allies together, to remain vigilant. It's not a bullying tactic. It's more of a vigilance tactic so that our allies don't get closer to China, because that has been happening in the last 10 or 20 years. A lot of our allies have been getting closer to Beijing, have been getting closer to Moscow. So, how do we keep them closer to Washington?
Jose, let me ask you about the labor market, because you got a big headline today that got some attention. It was Chevron cutting up to 20% of its workforce. When you see that headline, as an economist, Jose, do you write that off and say, okay, that's one company, it's one story, it's one anecdote, I can put that to the side, or does that suggest some broader trend to you?
Josh, there's some cracks in the labor market. With Chevron, the price of oil came down significantly, so it makes sense. Their margins are compressed a little bit. Oil was at $120 in 2022. Today it's at $72 or so. If you look at the last jobs report, the average weekly hours in a work week went down to 34.1. That's the lowest since March of 2020, the depths of the pandemic. Before that, you have to go back to 2010. That's a leading indicator. Why? Because employers begin to trim hours a lot of times before they lay people off. What else correlates with that? Leisure and hospitality employment actually lost jobs. Big discretionary sector, big sector where bartenders, waitresses, bussers have their hours trimmed rather than them being laid off. It's a big part-time culture in that industry. So I'm worried about that. Also, the breadth in the jobs report, very weak. Many sectors only added between 1,000 and 7,000 jobs. So we had a lot of concentration in just a few sectors, right? Of course, health services, education, government, those have been the consistent gainers. And payroll growth is going to slow down because you don't have that immigration impulse. There's no doubt that the strong number of entrants during the Biden administration from 21 to 25 led to higher payroll growth and economic growth. Most of those folks, when they come here, for the most part, economic prosperity via the labor market.
Jose, thanks for coming in. Always enjoy your visits. Appreciate it.
Thank you.
And next thing you know, we'll all be laying eggs. We're just getting started here on Market Domination. Coming up, shares of Lyft lower today as the company's weak outlook weighs on that stock. We'll hear from Lyft CEO David Risher later in the hour to discuss what's next for the rideshare. And at 3:40, United States Senator Elizabeth Warren, we will hear from her about her thoughts on all things inflation, Doge, and the future of the CFPB. Stick around, much more Market Domination still to come. The surprise inflation print initially hit stocks hard this morning, but we've seen a bit of a comeback ahead of the close. For more, let's welcome in Michael Kantrowitz, Piper Sandler Chief Investment Strategist. Mike, it is always great to see you. And we're hoping you can sort of shed some light, give some context for what investors are thinking today as we saw that drop and then stocks kind of coming back here. What is your thinking around inflation and why we're potentially seeing this reaction?
Sure. Good to see you again. So if we look in the morning when the initial data came out, we saw 10-year bond yields shoot up about 12 basis points to 4.66 and change. So we're 3 basis points off that now. I think the market is just super sensitive to changes in interest rates at these higher levels. And during the day, we've rallied 3 basis points on the 10-year, or the bonds have rallied, so yields are a little lower. And that has just a magnified impact on equities. You know, where you really see the impact of higher rates today is in leadership and the breadth of the market, which is pretty terrible. Small caps are down a bunch. Home builders are getting hit. All your rate sensitive areas are doing poorly. So when rates move up, it tends to hit those more rate sensitive parts the most. And if they move up high enough, like they initially did off the CPI report, it hits the whole market. But you definitely have a big size bias today. There's a handful of large cap companies that are really kind of carrying the indices, but underneath the surface, things are still, I'd say, pretty poor.
Michael, is the Fed done cutting this year, in your opinion?
I think they're done. To me, the Fed cutting story was mostly about unemployment moving higher. And I would say we're starting to see some green shoots that of the employment data that has softened. We've seen kind of a improvement in some of that data. We're also seeing other cyclical areas of the economy that have been really weak for the prior 2 years. Small business sentiment, ISM manufacturing data improving. So that, to me, with the green shoots we're seeing in employment, suggests that the labor market cooling is perhaps starting to stabilize. I don't think it's a huge change, but at the margin, stabilizing.
Something else I know you've been watching closely, home equity loans, which you say have been turning up in a pretty decided fashion here. And I can't figure out if you think that that is a good thing or a bad thing. In other words, if people are taking out home equity lines to pay for stuff, are they sort of because they're doing it at high interest rates, one would think. So does that mean they're not bringing in enough cash flow and so they're tapping that for spending? Yeah,
that could be part of it. And, if you think about it, you're better off borrowing from your home at 7 or 8% than borrowing from a credit card at 20%. So, no one really speaks to that same point about credit cards. So maybe it's, actually leading to lower interest expense if people are paying off their credit cards using their home equity loan. We also have an affordability crisis in housing. So you probably have more people that can't move and therefore are having to renovate their house because they had another kid or something and are taking a home equity loan as opposed to moving and shifting their entire mortgage. So I'm not. I think the answer is it's mixed. I don't see it as a big negative, and it's not a huge surge. It's about 9% growth in terms of home equity utilization or use, and that's nothing even remotely close to what we saw in the 2000s during the housing bubble. So I think it's a reflection or byproduct of the frozen housing environment.
So add it up for us, Michael. Given the backdrop we find ourselves in, the environment we find ourselves in, for viewers who are listening right now, how do they want to be positioned in the equity market? What are you telling your clients? What sectors do you want to be overweight?
Yeah, so the last couple of years, we've been recommending quality and growth, so kind of pushed us into larger companies. I think the big difference between a couple of big differences from the prior 2 years. Number one, we had 2 years of really strong equity returns led by, obviously, a handful of large cap growth stocks. But during 23 and 24, you had 2 consecutive years of credit spreads that were tightening and market multiples that were expanding. Those tend to go hand in hand. As we sit here at the beginning of 2025, credit spreads, so it's a measure of credit risk, are at the tightest levels in 20 years, which suggests to me that there's really no more upside for equity multiples from here, particularly if rates stay elevated and investors are worried about inflation and the Fed is done tightening. So I think, number one, we should expect single-digit equity returns this year really being driven by earnings. And the companies that can maintain earnings momentum in this environment, I think are going to single-handedly, really outperform. I think the difference from last year to this year, though, is that it's going to broaden out from just 7 stocks, and the breadth of earnings is going to improve as a byproduct of the breadth of the macroeconomy improving. As again, we look at manufacturing PMIs that are in expansion for the first time in 2 years. Small business optimism is improving. The Fed has cut 100 basis points. So it's not going to be an economic boom, but it's going to be better in the areas where things were weaker over the prior 2 years.
Well, and Michael, one other thing we haven't talked about as much is what's coming out of Washington. And I think investors are really struggling with whether, on balance, policies are a headwind or a tailwind, right? Because you have trade policies and tariffs on the one hand, you have the hopes for tax cut and extension, although we don't yet have that confirmed, of course. You have regulation, you have Doge in there somewhere. Like, how does all that balance out?
I don't know how it all balances out, because there are too many variables and too much uncertainty and too much flip-flopping in terms of these policies. So ultimately, as an investor, I think the way you want to think about it, since there is a lot of uncertainty, is really watch how it impacts interest rates. Because at the end of the day, it's not tariffs that are the problem. It's that if tariffs lead to inflation and push interest rates higher, that becomes the problem. So that is certainly, or over the last few months, why interest rates are elevated and inflation expectations have picked up. Though I would argue that it's really been more about sticky inflation and improving jobs data in terms of why rates are high. So in terms of avoiding the risks that tariffs could present to equities, whether it's because of inflation picking up or it's because of interest rates picking up, I think you just want to avoid stocks with poor fundamentals that are really dependent on interest rates falling and are lower quality. So a lot of small cap stocks that are very rate sensitive and are low quality. And so we would still stay with kind of the larger companies, maybe not the S&P Mag 7 this year, but maybe something of an equal weighted S&P index we would prefer than going deeply down the capitalization.
Mike, good to see you. Thanks a lot.
Okay, take care.
You too. Now time for some of today's trending tickers. We are starting with Chevron. That company announcing it's going to cut 15 to 20% of its workforce. The layoffs come amid its cost-cutting efforts, and various sources reporting that the company confirmed these cuts that were first announced in internal communications. The shares down about 1.5%. But this is part of sort of some other changes at the company, including it moving from California to Houston in terms of its headquarters, and the CEO, Mike Wirth, really focusing on harvesting cash flow. So this seeming to go in line with some of those other moves, perhaps.
Yeah, they employed about 46,500 people at the end of 2023. So you're talking about potentially 9,000 employees. So this potentially does affect a lot of folks. Companies targeting $2 to $3 billion of structural cost reductions by 26, saying in a statement they're taking the action they talk about simplifying the organizational structure, execute faster, more effectively. Stock has not done a whole lot. Just looking over the past 2 months, we're up about 2%.
Yeah, and there's just a couple of bigger picture things that we should be watching with Chevron. One of them is, as you alluded to earlier, the refining margins, which were weak both at Chevron and at Exxon last quarter. That is the cost of making crude oil into other stuff, including gasoline and other refined products. Not as profitable a business. Tariffs could potentially weigh further on that if you get your feedstock from Canada. So that's one thing. Secondly, we are still waiting for Chevron to buy Hess. Mostly for Hess's operations in Guyana, but Exxon's the third leg of that stool, and it's not clear how if they're going to give approval or how that situation is going to turn out. So that's sort of an overhang, one could argue, for Chevron.
It was interesting to talk to Jose Torres too, because you asked him whether this is kind of a one-time story and an anecdote, or whether he saw a broader trend of weakness in the labor market. He was in that latter camp, it sounded like. All right, Confluent shares surging. That says the company surpasses Wall Street's expectations for fourth quarter earnings and revenue guidance for the full year, and first quarter also pleasing analysts. So moving higher, Q4 results beat. Outlook obviously welcomed by investors. JP Morgan is overweight this one. Very encouraged, they say, by the solid Q4 results. Improving fundamental business trends likely sets up the shares, they told clients, well through the analyst day in early March.
Now, the company did beat last quarter. Its earnings per share forecast for the full year was just in line with estimates. But I thought it was interesting, Guggenheim analyst Howard Ma, his perspective on this. He says that might look conservative, but he says the guidance is not conservative because it would require 3% incremental subscription revenue growth, 8% incremental cloud revenue growth. In other words, under the surface, this would imply that there is growth happening at the company. Just a little bit of context here, by the way. The shares were down this year, over the past 12 months, going into today's report. So they've been sort of underperforming before this positive surprise.
Nice move in today's trade.
Yeah.
Coming up, we are speaking with the CEO of Lyft, that's David Risher, to discuss his company's latest earnings results and the path ahead for the ride share. Stick around. Much more market domination still to come.
Lyft shares feeling the pressure after reporting fourth quarter earnings. The company warning that a pricing war with Uber could slow bookings growth in 2025. Here to help us break down the report, Lyft CEO David Risher. David, it's great to see you as always, David. So talk to me about what you're seeing in terms of pricing pressure. That seems to be really what the street is focusing on.
Yeah, I think you're right. Let me back up for a sec. Hey, Julie, first of all, say hi to see you. Great to see you. So here's where I want to start. We just posted the best results of our history. And I mean, we had 16 billion in bookings. That's amazing. We did 828 million rides. That's every single one of those a ride to get out and about. I mean, that's amazing. And we're GAAP profitable for the first time ever. And we printed $766 million in cash. So that's amazing. So then you say, well, gosh, what's going on? And why is the stock market doing its little kind of freak out? And I think part of what's going on is we did see some, changing in pricing right at the end of last quarter. And it's fine with us. We're built for that. Like, we are literally built for that. When prices go down, rides go up, and we have better service than we've ever had. But I think that always gets people a little bit, kind of freaked.
David, it's Josh. It's great to see you. On that issue, though, of pricing softness, and it sounds like it started toward the end of the Q4, what do you see ahead, David? Does that continue?
I mean, look, our pricing strategy is to be competitive and reliable. So competitive means, what it sounds like, and reliable means every single time you open the app, we wanted to give you a reliable price. That's why we do things like price lock. We've driven down, prime time surge pricing by hundreds of millions of dollars last year, about 40%. So anyway, that's the sort of environment that we always look to create and to participate in. If somebody else in your marketplace starts to play around with pricing, you got to deal with it, and that's fine. Like, that's, again, what we're sort of built for. I can't really predict exactly the future. I would say there's plenty of demand out there, which is great for the market. We don't really see a need to play with prices much, but if it happens, we respond, and, as I say, competitively and reliably.
And you've been talking to us about your price lock feature for a bit now. It sounds like that has been working well for you in order, to help pick up commuters and folks at other times of the day. It sounds like there's some reporting that Uber may be introducing a similar feature. How worried are you about that? Do you guys plan to react in any way?
No, I'm not worried. I mean, so the thing is, you would expect this to happen, right? And I think, I don't want to cast too much shade, but maybe just a tiny little bit. I think, so our service levels, again, I'll start with that. We pick people up on average a minute faster than a year ago and 30 seconds faster than the other guy. Okay, so if that's happening and we're seeing our market share increase year after year after year, then if you're them, what do? Well, maybe you drop prices. Maybe you start, copying other people's features. So I think you're going to see some of that in the marketplace, but our job is to stay ahead, right? So we've already improved price lock a bunch. In fact, we just allowed you to start pausing it whenever you want to and resuming it when you want it again. You can use it 24 hours a day now. We call it price lock around the clock. So, our job is to serve riders and drivers and to connect people, and we're going to keep sort of trying to innovate, and then maybe other people will use that as inspiration, let's say, to try their own thing or to catch up with us.
David, switching gears to another topic, you all do look to be the partner of choice for autonomous vehicle companies. Yeah. So does Uber, David. And some analysts who cover this space, and they cover you, they cover Uber, I have seen them tell their clients they think that Uber is better positioned, and they'll talk about scale, they'll talk about global presence. To that argument, you say what, David?
Yeah, so I say I disagree, and here's why. So particularly on the scale side, we give 800 million rides a year. That's 2 million rides a day. Gosh, that is plenty of scale to generate the type of demand that autonomous vehicles need, who right now are measured in the hundreds. And that's not to disparage at all the work that the autonomous guys have done. It's amazing. But each one of these cars is hundreds of thousands of dollars. They all require custom tooling. They require sensors. So demand generation, we've got, all you need there. And then something we have that nobody else has is fleet management expertise. We've been buying and running, cars on the fleet, about 10 to 15,000 or so, at any given time. And that's everything from maintenance to cleaning to understanding how long repairs should take to figuring out how to keep them back on the road, which is how you make money with autonomous. So I think when we're as you said, Josh, our idea is to become the best partner. And I think with the demand we have, the fleet utilization, and then of course, 10 years of rideshare experience to actually match supply and demand 24/7, I think we've got everything you need to be a great partner.
And David, how do you think of what autonomy is going to do for you all in terms of, in other words, is it going to be a must-have going forward because of your competitors? Is it going to be something that's going to be a profitability driver? Is it going to be a volume driver? How do you think about it?
Yeah, I love this question. So I do think it's going to be a must-have, to be clear. I think I think someday all cars will be autonomous, right? I mean, it might be 10 years down the road, but I think you buy a car 10 years from now that's not autonomous, it'd be like buying a car without headlights, I mean, so I think it's going to be very, very basic. And for that reason, people are going to expect it on a rideshare platform for sure. Now, what we're seeing in the marketplace is kind of interesting. They're fairly small scale tests, right? We're talking about a couple hundred cars here, maybe 500 cars there. But let's look in Phoenix, for example. In Phoenix, our growth is actually growing faster than it is across the rest of the United States, even though it's a very competitive market, including autonomous vehicles. Why might that be? That might be because people come and they take an AV, tends to be a very good experience, but it takes a little longer, it doesn't go everywhere in the city and so forth and so on. And so, people might start there and then they'll come over to Lyft. As I say, we're seeing our share grow there, even as, AVs like Waymo have started to proliferate.
David, a final question, kind of a broader one. I'm always curious just to get your take, David, on the American consumer, because you do have some unique line of sight there. The economic data points we get, David, suggest this consumer is hanging in there, resilient. I'm curious what you're seeing.
We see the same. Broadly speaking, at the scale we operate in, again, millions of rides every day, we really are very much part of people's lives. It's why Price Lock has worked so well. It's why our on-time pickup promise for airports is so important, because people literally take us to go to the airport hundreds of thousands of times every day. So, I am sort of pleased to say that we see a lot of strength on the demand side. I will tell you, if you'll indulge me, one 30-second fun anecdote. We see trips to bars, of course, airports, bars, commute, all these different use cases. But because of dry January, we actually saw a drop in trips to bars. It was actually a little greater than it was in prior years. So there's a little consumer insight. I will tell you, however, we just looked at this yesterday, they're back up even a little bit above where they were last year. So we've got pretty good growth right now. So I think that whole dry January thing, it kind of came and went. But big picture, we're seeing a lot of strength.
David, it is always great to see you, always great to have you on the show. Thanks for joining us.
Thanks, you guys. Hey, book your Valentine's Day ride out now. Black car, it's a great experience. Get out there, hang out with your sweetheart.
Consider it done. Thank you, sir.
Awesome. Take care, you guys.
The Consumer Financial Protection Bureau was created in the aftermath of the 2008 financial crisis and was championed by Senator Elizabeth Warren. Now, the CFPB is firmly in the crosshairs of President Trump and Elon Musk. And joining us now with more is Yahoo Finance's Jennifer Schonberger. Jen.
Hey, Josh, that's right. With the Trump administration freezing the CFPB's operations, I spoke with Senator Elizabeth Warren earlier this afternoon about just that, as well as consolidating bank agencies and lowering interest rates. Take a listen. I want to kick off the conversation with the letter that you sent along with 200 of your colleagues to the CFPB and Treasury Secretary Scott Bessent earlier today, calling for them to unfreeze operations. But I'm curious, are you prepared to take legislative action? What are you prepared to do? What can you do as senator to uphold the CFPB and keep it operational?
Well, let's be clear. We've already taken legislative action. It is Congress that created the Consumer Financial Protection Bureau. And it is only Congress, not Donald Trump, not Elon Musk, not some guy in off the street, who can actually get rid of the CFPB. So the law is there. The law is unambiguous. The law is clear. What we want is for the DOJ co-presidents to simply abide by the law. And if they won't do that, then we got to go to court and make that happen. But the law's already done. There's just nothing more to do.
Mm-hmm. I'm curious, the CFPB, obviously your brainchild, near and dear to your heart, and it seems like it's constantly caught in the political crosshairs. Right now, with being frozen by the Trump administration, last year its funding structure was challenged. Ultimately, the Supreme Court upheld it. In the first Trump administration, we also saw officials try to gut it. I'm curious, is there a way you would be open to bringing the CFPB into the appropriations process as a way to stabilize a lot of these forces at play and keep it operational?
Look, let's be clear. The folks who want to kill it want to kill it. They don't want to change it a little bit. The appropriations argument has always just been a smokescreen. Starting, read do a little history, starting in 1863 with the first bank regulator, the Office of the Comptroller of the Currency. Congress decided that bank regulators should be outside the appropriations process. And the reason is pretty straightforward, because Congress, even back then, worried that the big bankers and their lobbyists would come in and influence elected officials to go easy on the banks. So they said it's important to retain independence. And that is why every banking regulator, not just the CFPB, but every banking regulator is regulated outside the appropriations process. You know, the Republicans and the bankers have taken the CFPB all the way to the Supreme Court twice. They have failed both times. But what's interesting about that is there are a lot of folks who said, wait a minute, you try to unravel the CFPB and you unravel other big parts of how we run our banking regulatory structure. Remember right now, for every consumer protection law on credit cards, on checking accounts, on car loans, on payday loans, on student loans, every one of those, the CFPB is the cop on the beat. And what co-president Elon Musk has done is he has told all the cops, quit doing your job. That is not making anybody safer, and it sure as heck is not lowering costs for American families. Donald Trump promised he was going to lower costs for American families, and instead he is raising costs for American families if they're going to get cheated because Elon Musk has taken the cops off the beat.
Two follow-ups there. Wall Street Journal reporting that the Trump administration is talking about trying to consolidate bank regulators without the input of Congress. The article says they're looking at folding the FDIC into the Treasury and combining the FDIC with the OCC. Your thoughts on that? And given that Congress is the body that creates regulatory agencies and would dismantle them, without support of Democrats, is this a non-starter?
You know, you have that part of it exactly right. Congress created these agencies, all of them, and only Congress can end them. But can we just stop to say for a minute what a really bad idea that is? Do we really think our financial system is going to operate better if we get rid of the FDIC insurance? Do you really want to be there the day that they're scraping the FDIC insured stickers off the entry doors to the banks all across America? I don't think so.
Senator, do you have concerns about DOJ and Congress's ability to retain control of the purse strings?
So the law is clear on this, and the courts will enforce the law if Elon Musk and Donald Trump break it. That's how our system works. That's right there in the Constitution. This isn't even very fancy. You don't need a law degree to understand this part. Congress has built these laws. The administration is not doing the job it promised to do, and that is lower costs for American families. Instead, it's out there creating more chaos and, in fact, raising costs for people across this country and causing a lot of disruption in our economy. You know, trying to shut down an agency, trying to fire tens of thousands of federal employees, breaching federal contracts, again, in violation of law. This is an administration that is creating more economic chaos and ultimately increasing costs for families. They need to work on getting costs down.
Senator, switching gears a bit, ironically, one thing that you and President Trump seem to agree on is lowering interest rates. In fact, you called on Fed Chair Powell at yesterday's Senate Banking Committee hearing to lower rates at the next policy meeting. I'm curious, though, Secretary Scott Bessent has said that the administration wants to bring down long-term borrowing costs by targeting the yield on the 10-year Treasury, which, as you know, affects so many borrowing costs in this economy, particularly mortgage rates. I'm curious, what are your thoughts on that?
Look, I have urged the Fed to bring down interest rates for a long time now, because I want to see families be able to afford mortgages and pay off their credit cards and buy a car without car loans being sky high. I understand the concern that Chair Powell has right now when we live in an on-again, off-again, on-again tariff environment, on again, off again, firing tens of thousands of federal employees, breaching federal contracts all over this country, trying to shut down child care centers around the country, and firing financial cops who are the people who make sure that consumers can keep using those credit cards and checking accounts without getting cheated. There's a lot of economic turmoil right now created by Elon Musk and Donald Trump. And I understand how that gives the Fed pause. I still want to see those interest rates come down. I think it's the right thing to do. But we also need to stop this economic chaos. This is not helping American families.
Senator, before I let you go really quickly, you've been talking about inflation, trying to bring prices down. We did get a new reading on the consumer price index this morning. Food prices up, egg prices, of course, up because of the avian flu. I know historically you have been out to egg companies in this country, calling on them to bring down their prices, calling them out for price gouging. What is Congress prepared to do to try to bring down food prices for Americans? Is this about investing in the food supply?
So look, I can tell you what we don't want to do, and that is what Donald Trump has done, and that is taking down information off the National Institute of Health's websites on avian flu so that we can work together to try to stop the spread. That's a way that you try to get a crisis under control and keep prices down. Right now, the Trump administration has the tools. They made the promise. Donald Trump said repeatedly on day one he would bring those prices down. He said repeatedly he could do it immediately. He knew what the tools are. Why isn't he using those tools to bring down prices?
Senator, we'll have to leave the conversation there. So many questions, so little time. So appreciate your insight. Hope to speak with you again soon.
You bet.
Time now for our call of the day. Tesla shares riding higher today with benchmark initiating coverage at buy, price target of $475. Analyst Mickey Legg saying he believes the robo-taxi provides a huge opportunity for the company, and he sees the release of more affordable Tesla models in 2025 as a key catalyst for the stock. I mean, the context is important here. The stock is down 5 days in a row coming into today, and it is down more than 30% from its record high in December. So a little bit of a snapback here.
Yeah, it talks about how increasing competition and uncertainty about both the regulatory environment and EV demand growth, he talks about, are putting downward pressure on vehicle pricing. However, he says we believe the breadth of product development should address these issues. So sounding more optimistic, confident tone there.
Yes, so we'll see if the sustainability, if they can keep, the shares can keep going higher. Sorry. All right, let's talk about another ticker that we are watching today. Shares of CVS. They are surging. The company reporting a big beat on fourth quarter earnings. Joining us for more on the health of CVS, Yahoo Finance's Anjali Kamlani. So what was driving the performance here?
Well, surprisingly, they're still under pressure. Don't take these the earnings as any change from what we saw in the last year, and that is what we heard from new CEO David Joyner. The company is still pursuing, trying to figure out the sweet spot when it comes to Medicare Advantage and the costs there, and how seniors are utilizing healthcare, as well as trying to stay competitive in the pharmacy area that we know is constantly an area of pressure. Despite all these headwinds, they did come out with a beat compared to what Wall Street was expecting. Now, the new CEO, new since the ousting of Karen Lynch late last year, is taking a more conservative approach, and that's something analysts seem to quite like from the call that we saw today. Just take a quick look at the numbers without even getting into 2025 outlook and full revenue. We did just get an adjusted EPS of $5.75 to $6, and then as you see on your screen, revenue beating the estimates just by a little bit to $97 billion was still within the range. So looking at that full picture, we see that the company is still struggling, and I had a chance to speak with the new CEO. He did tell me that the company plans on maintaining that kind of conservative stance and knows that it has to build back trust with the investor base on some of the topics from last year. He also did say, in talking about how the pieces of the company are coming together and how he views them, that, quote, "This will be a bold statement, but I believe we changed the market. We are driving changes and rationalizing the pricing formulas in this marketplace. So this is not a one-off. This is truly where I believe the market is going." That was in particular about CostVantage and True Cost, which we know is sort of the Mark Cuban style, flat rate and markup on prescription drugs. And that's an area of a lot of pressure for the company. We know Congress is still looking at really, clamping down on PBM. So
wait, so explain that a little more for us, for those of us who are not steeped in this.
Yeah, so CVS last year, or even in 2023, I believe, started the process of introducing a flat rate plus a markup, kind of like Mark Cuban's Cost Plus Drugs, on some of the prescription fillings. And based on implementing that, the company now says that they are able to meet filling prescriptions not at negatives and not squeezing in the way that the sort of black box PBM system that traditionally is in place works, where you don't know how much is going to the middlemen for the rebates, you don't know what the actual price is, you just know the list price and what you're paying. And somewhere in the middle of all of that, someone is getting some of that money. So changing that process, and he believes that along with providing healthcare services is going to create a new CVS, if you will.
All right, Anj, thanks for the update. Appreciate it. While we are wrapping up today's market domination, don't go anywhere. We've got you covered with all the action following the closing bell, including the latest earnings from Robinhood, Reddit, Cisco, and many more. Stay tuned for market domination overtime.
That's the closing bell on Wall Street, and now it's market domination overtime. Let's take a look at what we saw when all was said and done today. We have the Dow falling by 225 points or so, about 0.5%. The S&P 500 off by 0.25%, and the Nasdaq very, very slightly in the green here. All of this in the wake of a CPI report, consumer inflation report, that came out this morning, hotter than estimated, both on the core and on the headline level. So raising some alarm bells for some strategists who, in addition, were taking their cues from what we saw with the 10-year, where we saw a big move up about 10 basis points, or 1/10% in that rate. It was interesting, the conversation we had with Michael Kantrowitz earlier, Piper Sandler, because he pointed out that even though we saw, for example, the S&P kind of come off the lows over the course of the session, if you look underneath the hood, things didn't look great. For example, the equal weight performing worse, which indicates more broad breadth decline. So broader declines there. Small caps doing worse. But even with within the small caps, the S&P 600, which is the more profitable of the small cap companies, down more, 1.3%. And then he also talked about the sectors and where we were seeing the most acute selling. So even though we saw the S&P coming off the lows, there were only two groups, well, and consumer discretionary, not really in the green, call it flat, and communication services, very little change to the upside. And then you saw selling in areas like energy being led lower by oil prices, real estate lower, materials lower, industrials, financials. So definitely saw some selling concentrated in certain areas that are more rate sensitive here as we saw those rates push higher a little bit. I'm going to call it the leaderboard too, which is a favorite of our friend Jared Blickery. This looks at some of the more market-leading groups within the market, that is. So we had K-Web, Chinese internet stocks doing well, along with ARK up, the GBTC Bitcoin higher today. And then on the flip side, we had regional banks and home builders. Again, rate sensitivity really helping lead some of the declines that we saw in today's session. Josh?
All right, thank you, Julie. Stocks closing mostly lower, but off the worst levels as the consumer price index for January did come in hotter than expected. Market participants now pushing back expectations for the next rate cut into the second half of the year, and Fed Chair Jerome Powell reiterating on Capitol Hill today that there is still more work to be done on inflation. Well, joining us now is Vincent Reinhardt, BNY Investments Chief Economist. Vince, always great to see you. Let's start with that CPI report, Vince. Topped forecast, obviously surprised a lot of folks. Did it surprise you, Vince?
Last mile in reducing inflation is hard. A lot of the progress we got, a lot of the favorable headlines, particularly last year, were related to energy prices, were related to fast-moving, flexible prices that are below the Fed's goal of 2%. But the slow, inertial stuff, services, the things that are the result of individual decisions in lots of places, not lined up in time, they really move slowly. And that's what's happened. Slow-moving prices are, still increasing on the order of close to 4% last month. In that environment, you're not going to get to 2 quickly. That's what everybody's got to appreciate. Last mile is hard.
And even something that was supposed to be improving, Vince, it's Julie here, good to see you. Shelter inflation, right, which had been trending down, saw a little bit of a resurgence this month, and that's got to be something that maybe concerns the Fed too.
Yeah, that was a surprise. Shelter had, as you noted, monthly changes had been pointed down. My suspicion is that the folks at the Fed will slice and dice the data, compare it to the big data sources where they get real-time information on shelter prices, and probably conclude some of it is just seasonal. It's the beginning of the year. People rewrite contracts at the beginning of the year. Maybe it was a slightly larger change than normal.
Vince, is the Fed done cutting this year?
So that it's a much better question today, right now, than it was at 8:29 this morning. I think that's right. Look, where is the Fed positioned? And And if you look at their last forecast, if you look at the statement, they're leaning a little over the board. Their last direction was down. That does suggest that they're at least inclined toward easing. But the case has got to be made, and it's not made now. Fed's real problem, which is why, this inflation outcome was actually probably good news for Chair Powell, is that their concerns about inflation wasn't last month's shelters number, wasn't the general slow-moving nature of sticky price inflation. That's all backward looking. And that's pretty much playing out how you might have thought. Our forecast didn't have much progress in reducing inflation and only had the Fed easing just twice this year. Got to trim that back, of course. The problem for the Fed is forward-looking, that if the White House puts in place some of the policies it's discussing, that will add to inflation. But if you're Jay Powell, you can't go on Capitol Hill and say, we're not going to change rates because we're worried that President Trump's policy is going to add to inflation this year. What can he do now? He can look back and say, inflation a little hotter than we thought, good enough reason to wait. They got a better reason to wait. They should wait until they see the results of some of the administration's policies and what that does to inflation.
Vince, quick question, because we were talking to another economist earlier in the show today. I asked him, what are the chances, what are the probabilities that actually the Fed raises rates this year? He put it at 25%, Vince. I'm curious, you agree with that call?
Too high. And that's because the Fed's got some margin between where it is now in its overall position of policy and to the point where it cuts rates, raises rates, sorry. Its guidance is still saying that it will cut rates. So the first line of defense will be to revise the guidance up. That's the equivalent of tightening policy. Second line of defense, try to shape longer term expectations. That is, what they start talking about the equilibrium or long-term policy rate. That starts moving up, then the longer end of the yield curve will reflect the sense that Fed policy will be tighter for a long time to come. If you can convince markets that rates are going to be tighter for a long time in the future, you don't actually have to move right now. And, it's not exactly a vote of confidence, or at least Fed officials would probably think that, to have embarked on a big easing with a 50 basis point cut just in September, and then turn around and start raising rates.
Right.
So they'll put it off if they can.
Well, for what it's worth, the same economist we spoke to earlier said that 50 basis point maybe wasn't the best idea, but...
Yeah. History always reads better after the fact, right?
Fair enough. Vince, I want to ask you one final question. You mentioned the potential effect of tariffs if they do stick around. I want to ask you the potential effect of something else that the government is doing. And I'm going to read a tweet from Elon Musk, or a post on X from Elon Musk earlier today. He said, as it becomes clear that Doge is working, you will see the long-term Treasury bill yields fall, and all Americans will benefit from lower interest payments on mortgages, small business debt, credit card, and other loans. Do you agree with that assessment? Is that how you see that playing out?
I believe in the mechanism that if Washington, D.C. were to credibly signal that the budget deficit is lower now and is on a trend that not to deteriorate, that the Treasury would be rewarded in markets, yields would go down. However, my concern for Elon Musk is the budget deficit didn't get there because of decisions on by a lot of independent federal agencies staffed by remote bureaucrats. Congress is the co-conspirator. Congress authorized spending. Congress authorized tax cuts, and that Congress is going to start pushing back, as your interview earlier with Senator Warren might suggest, that the agencies they created should be able to spend what they authorized. So yes, mechanism is right. Make progress on the deficit. Reverse the trend of deficit deterioration at least. And you'll get rewarded in capital markets. However, capital markets are going to wait for something durable. And durable is to get the government of the United States to agree to a more sane fiscal trajectory. That's not done by tweaking payment flows.
Vince, it is always great to see you and have you on the show. Thanks for joining us, sir.
Thanks for having me.
Cisco Systems shares, they are rising right now. Look at that, tacking on nearly 7%. That's following their second quarter results. Let's get into those numbers, Julie. Q2 EPS 94 versus 91. Revenue 13.99 versus 13.87, so beats on the bottom and the top. Looking ahead, Q3 EPS 90 to 92 versus 90. Q3 revenue, they're calling for 13.9 to 14.1. That's versus expectations of 13.88. Now let's turn to the full year and the outlook there. Full year adjusted EPS 368 to 374. They had seen between 360 and 366, so that is a boost to that profit outlook. The revenue, they're now calling for between 56 and 56.5. They had seen between 55.3 and 56.3 billion. So the immediate reaction, you're higher in the after hours.
Yeah, and I'm just looking through the statement here from Chuck Robbins, the CEO. He talked about accelerating customer demand for their technology. And he said, as AI becomes more pervasive, we're well positioned to help our customers scale their network infrastructure. So it definitely seems like they're pushing the AI narrative as part of what is driving demand here, which makes sense given that what we're seeing in terms of the infrastructure build out. So as you said, those shares are rising about 6%, Josh.
Yeah, companies' core networking markets, that'll be in focus. What color does Mr. Robbins give us on the call about that, the trends they see ahead? Public spending, that's always in focus too. Splunk, I mean, some on the street see that Splunk integration, they tell clients, does remain some upside opportunity in their opinion, could mean better than expected operating margins, they think ahead. Tariffs too, I'd be interested to see kind of questions that Chuck Robbins gets on the call about that issue.
Yeah, definitely. Let's also get to Robinhood. Robinhood out with its latest numbers here. That company coming out with revenue of $1.01 billion. That's ahead of the $941 million or so that analysts had been anticipating. Crypto revenue driving some of those gains, as analysts had projected. $358 million in crypto revenue specifically. That was above estimates. Assets under custody in the fourth quarter reaching $193 billion. That too above estimates. The company's earnings per share coming in at $1.01. I've got to look and see what the comps are for that one. It looks like that is a beat of estimates. And really what analysts, investors were looking for here indeed was some of the crypto enthusiasm driving the volumes, driving the action on the platform. And it looks like that indeed was at least part of what drove the beat here for the company and what's driving the shares higher.
This stock was already up about 365% over the past 12 months. I mean, just an incredible run. I mean, a lot of enthusiasm. In part, there were certainly investors, Julie, who were betting on this as a win from a company that would benefit from having a new crypto ally in the White House. I think what execs see ahead for that market will be interesting. Interest rates higher for longer, what they mean for that business. I just find Robinhood an interesting company and evolving story. You know, it was brokerage services and commission-free trading, and now Vlad expanding into all its retirement and credit cards, just to try to attract more investors and different kinds of investors to the platform.
And to your point, kind of the ecosystem and the engagement on the platform, they have this gold subscription program now, and they tout some of the numbers there. Gold subscribers up 1.2 million. That is an 86% year-over-year gain. They now have 2.6 million of those gold subscribers as they've really been pushing that program of some of their most active customers, I guess you would say. So that helping matters as well here. And basically, the company just touting all of the records that they reached in the quarter in their statement here. They talked about Vlad in the statement saying we hit the gas on product development in 2024. To your point, like really rounding out Robinhood beyond just a brokerage platform with all these other services, a new platform for active traders, he said, the gold card launch, expanded EU and UK product suite, So just a few examples of what they've been doing.
Also, how we both just refer to him as Vlad. Just informal.
Sure.
It's a friendly show.
It's like Cher.
It really is. Coming up, Reddit shares are sinking following their latest earnings results. We're going to get you those numbers on the other side. Stick around. Much more market domination over time coming up.
I should have said it's like Zendaya.
Shares of Reddit tumbling here in the after hours. That's following their fourth quarter earnings results. Let's get you those numbers. So Q4 adjusted EBITDA, 154.3 million. Estimate was 128.7. So that's a beat. Net income, 71 million versus estimates of 46.9. Also a beat. Revenue tops 427.7 million. Street was closer to 405.5. Here's one issue, 4Q daily active users. Now that clocks in at 101.7. The street had modeled closer to 103.81. That's the issue. Turning ahead, let's look what they see for Q1. They're modeling Q1 adjusted EBITDA. They're calling for between 80 and 90 million. The street was at 72.3. For Q1 revenue, they are calling for between 360 and 370 million. The street was closer to 358.7, but the immediate reaction here, we're down about 17%. We should mention, of course, that this stock has been a monster since its IPO last month.
Yeah, and that's important. And it's also a relatively heavily shorted stock because about 16% of the float is sold short, so people have been betting on declines here. That gain in daily active users, by the way, was 39%. Much of that growth, although not all of it by any means, happening internationally. International daily active users up 46%. In the US, up 32%. And similarly, when you look at just the growth that this company is seeing, that revenue number that you mentioned, Josh, is a 71% year-over-year increase. Ad revenue is part of that, up 60%. Gross margin for this company, 92.6%.
Yeah. Wow.
Like you don't see those numbers very often, even at tech companies, a number like that. And yet, it feels like, maybe some of this outlook was priced in. And some of this outperformance versus estimates was priced in, hence that little disappointment on the daily active users triggering that kind of selling.
Yeah, so we'll look for color on that. What does explain that miss on DAUs? More color on overall demand, the new products and features for users, and also data licensing negotiations. I know analysts are clued in on that. Any more hints, indications that maybe another deal with a big AI player could be on the way?
Yeah, exactly. Well, let's get back to Cisco now. Shares of Cisco rising as the company tops second quarter estimates on the top and bottom line. Cisco announcing an additional $15 billion authorized for stock repurchases as well. Morningstar senior equity analyst William Kerwin joining us now with a closer look. Well, it's good to see you here. So corporate spending seems to be lifting Cisco. The company saying everybody is building out their AI infrastructure. That's helping them. First of all, just give us your overall reaction to the numbers.
Yeah, thank you for having me, Julie. So the numbers were quite good. They beat our expectations for the quarter, and the third quarter guidance was pretty positive, more in line with what we were modeling, which was a little bit above the street. But the full year consensus, or the full year guidance, was better than we expected, which shows a pretty good Q4 implied after that Q3. And really, to put this in context, we think this is just continued good growth momentum for Cisco after a few years of some choppy demand with over ordering and subsequent inventory digestion by its customers. We think this is better reflecting a healthy demand environment now. But to put this all in perspective in terms of the stock price, we saw Cisco as overvalued coming into the earnings, and really we see that reflecting a bit of overexuberance around the impact of AI on its actual results. Now, we think AI can become a multi-billion-dollar business for Cisco, but against a $50 to $60 billion top line, we don't see it as a primary driver. But overall, good results, good guidance.
On that issue of AI, William, so Cisco's Chuck Robbins talking very confidently about that, says here, as AI becomes more pervasive, we are well positioned, he says, to help our customers scale their network infrastructure, increase their data capacity requirements, and adopt best-in-class AI security. When you're thinking about this name, both now and ahead, William, do you consider Cisco a smart way to play that mega AI trade and trend?
Not really. We think AI will benefit the business, both from infrastructure buildouts that use some of Cisco's networking equipment, but also we think Cisco is a prime candidate to use AI. There's been a lot of talk in the past few months about AI agents, and Cisco as this massive global sales organization could really benefit a lot from that. But it's not a pure play on AI. Again, we see AI infrastructure as a small minority of the overall business. We look to a networking peer like Arista Networks as a much better way to play into that AI networking trend.
William, at the same time, it's interesting here that the company is coming out with this raised forecast for the full year, because the backdrop here is that we've had some questions about what corporate spending is going to be, ex-AI corporate spending is going to look like this year. You've had some questions about the sort of macro environment, including the sort of policy and tariff potential headwinds, as potentially affecting companies' decision-making on spending. But that doesn't seem to be reflected in these Cisco numbers, or is that the right way to read this?
We think that the Cisco customers, what Cisco is selling is a very non-discretionary expense in terms of data center infrastructure, on-premises networking equipment. We don't think this is going to fluctuate a ton in terms of what that end demand is quarter over quarter. Now, I think it's a fair argument to have over a long-term period, the next 3 to 5 years, but we think this is a stable growth environment for Cisco, and we continue to believe that on-premises networking, not the high-flying AI type stuff, but campus networks and office buildings at college campuses, et cetera, are really the firm's bread and butter, and we see that as a durable, although low grower into the medium term.
William, what about potential tariff risk? Is that something that should be on Cisco investors' radars?
It certainly will be on radars, and I would be shocked if we didn't get a question on it on the earnings call coming up this afternoon. But I think it helps to look back at recent history for Cisco. Back with the first round of tariffs in 2017 to 2019 era, there wasn't an enormous impact, and we really credit Cisco's execution there in terms of mobilizing, again, this global sales force. So we don't expect there to be a massive impact for the company this time around, but we'll see what the company and Chuck Robbins says tonight.
Looking forward to that call. William, thank you so much for your perspective. Appreciate it.
Thank you.
Let's take a look at what's trending after hours. Shares of AppLovin jumping after reporting a beat on the top and bottom lines for fourth quarter earnings. The company posting stronger than expected guidance for the first quarter as well, as it expects revenue to come in between $1.36 and $1.39 billion, above the street estimates of $1.32 billion. The stock has been on a tear over the last year, up more than 700% for APP.
Staying in the ad tech space, shares of Trade Desk that are sinking after posting mixed results for the fourth quarter. Company topping estimates on the bottom line, but missed revenue estimates, and guidance for the first quarter came in below estimates. Street was looking for first quarter revenue to come in over $580 million, while the company's estimating above $575.
And finally, take a look at shares of Dutch Bros soaring after hours. Fourth quarter revenue coming in well above analyst estimates, and Dutch Bros posting stronger than expected full year revenue guidance, as they estimate they're going to bring in between $1.56 and $1.58 billion in 2025. The shares soaring 26%, but they have been lagging as of late.
Time now for what to watch Thursday, February 13th. Starting off on the earnings front, more corporate reporting is coming throughout the day, including Deere & Company, Applied Materials, and Coinbase. Coinbase announced results for the fourth quarter after the closing bell. Analysts expecting the crypto exchange to continue riding volume and price momentum in Q4 as investors embrace the rise of crypto under the new Trump administration.
Taking a look at the economy, more fresh inflation data coming out in the morning. This time, producer prices, PPI. Economists forecast both total and core PPI will tick up on a month-over-month basis to 0.3 and 0.2% respectively. This coming after inflation on the consumer level picked up speed again with the consumer price index, further complicating the Fed's path towards its 2% target.
And moving over to housing, weekly mortgage data from Freddie Mac is coming out in the afternoon. Last week, we saw mortgage rates dropping for the third straight week, with the 30-year fixed falling to 6.89%.
That'll do it for today's Market Domination Overtime. Be sure to come back tomorrow at 3 p.m. Eastern for all of your coverage leading up to and after the closing bell.
But don't go anywhere. On the other side of the break, it's Asking for a Trend. I've got you covered for the next half hour with the latest and greatest market room stories so you can get ahead of the themes affecting your money. Stay tuned. Hello and welcome to Asking for a Trend. I'm Josh Lipton, and for the next half hour, we're breaking down the trends of today that'll move stocks tomorrow. There's a lot to keep track of, so we're focusing on what you need to know to get ahead of the curve. Here's some of the trends we're going to be diving right into. Another turbulent day for markets following that hotter than expected CPI report, with the Dow and S&P both closing in the red. The Nasdaq managing to eke out the slightest of gains. We're going to dive into the rest of today's market trends. Then, is big spending finally catching up to big tech? We'll tell you why it could be time to invest in smaller cap tech companies. Plus, there's been lots of talk about the impact of tariffs on things like whiskey and appliances, but drivers could be in for a bumpy ride thanks to a rise in car insurance prices. We'll connect those dots in just a little while. Well, one of the key trends from this earnings season is big tech betting big on AI, but our next guest says investors can also look at smaller mid-cap names like Reddit, Pinterest, Snapchat. Here to explain why is Cameron Ansari, Headline Venture Partner. Always good to see you in studio.
Good to see you again. Thank you.
So, Cameron, let's talk about these many names. So, one on your radar was Reddit.
Yeah.
They reported after the bell today. They're in the red in the after hours. Or maybe some disappointment about Q4 user growth. Of course, the stock had also been a rocket ship since the IPO in March. But I'm curious, you name Reddit and Pinterest and Snap, and your point being, hey, these are the kinds of names that maybe we see stronger investor interest in going forward. How come? What are there common themes and trends that connect these?
Well, the big four names, right, that reported in the last week, Meta, Amazon, Google, and Microsoft, each of them reported massive upticks in CapEx on AI
spend.
It's it's an arms race, and now China's entered the market as well, obviously, and so it is a real race to get ahead and build foundational models and foundational layers right now to build put the concrete and the cement in and the steel to build your house on top of, right? So they're investing for the future, and you saw three of those four names. They're down about 5-10% this week. The one that's not is Meta, and the distinguishing feature is the other three are spending in order to then resell AI services to clients and businesses, whereas Meta's really building it for their own internal use to make their ads more effective, to make the targeting more effective on Instagram and WhatsApp and Facebook. So it's all for internal use. I think investors feel that's a better investment, and so Meta's been rewarded with a monster week. They're up 5-10% this week, with the other three are down. And then you have the other three names that I mentioned. Obviously, I spent a lot of time at Pinterest. I know that name best.
Yeah.
But those are smaller companies that are not in this arms race, right? They're not spending on giant AI data centers to power reseller businesses to do data cloud like Google Cloud or Microsoft's Azure service. These are consumer-oriented names, high margin. They operate simple businesses where they sell ads. And so they're not in this CapEx race. They're basically monetizing their own users, which is why when a Reddit misses on user count, you see the big hit, because the name of the game is eyeballs.
Let me ask you, in this mega AI trend we're talking about, small cap, big cap tech spending, what did you think of DeepSeek, this allegedly cheaper open source AI model? When that hits, there's a lot of people guessing, well, what does this mean for the broader trend in trade? How did you see it?
I mean, it was like an extinction event last Monday, right? When the news came out, NVIDIA, I think, was down $500 billion, the single largest single-day loss of market cap in the history of the U.S. stock exchange. So, people obviously panicked. I think they probably over-panicked a little bit. It's hard to know what's real and what's not. Obviously, with news coming out of China, is it really as cheap as they say? Is it really work as well as it does? Obviously, developers are not building on it. They're banging on it. They're going to take weeks and months to find out, hey, is it as good as OpenAI or not? We're not going to know overnight. But the fact that it even exists and offers an open source solution that's compared to OpenAI. And OpenAI, one of the things we should talk about is the real cost of OpenAI has been deeply subsidized for customers by Microsoft. So most customers in the US use OpenAI, and probably half my portfolio now uses it in some way or another. They're not paying the full price, right? They're not paying the full rate. They're paying the discounted rate that you get on like Expedia or something, not the rack rate, the hotel. At some point, the price is going to have to go up to the rack rate, right? Because OpenAI is hemorrhaging cash. They're spending so much money on these things. And so when the real price hits customers, are they going to be willing to pay it? Or are they going to go to an open source model like DeepSeek? And that's the real question. And the big challenge also DeepSeek brought into the market is it shattered the illusion that somehow there'd be like American exceptionalism in AI and made everyone wake up to, hey, look, no, this is going to be a global event. China's coming up really fast, and there are going to be other companies here.
I have to get you, since you're talking all things AI, final question. As a venture investor, right, you're talking to a lot of smart founders and entrepreneurs. What excites you when you're looking for opportunity right now? What verticals, what sectors?
you're seeing a lot around services businesses like, let's say, accounting, legal, marketing, and taking those and applying AI and creating like applications that do those more efficiently. Those are springing up very quickly, and I think they're going to become commoditized. The ones within the fintech space where I focus, where I think AI has real value, one is around service, customer support. You saw Klarna reduce their headcount by like 900 people or something remarkable by moving most of their service to AI. So in businesses that have a heavily consumer component, they're relying on customer service and help desks, to leverage AI to reduce that headcount, that's a big deal. The other areas are fraud prevention, as well as onboarding and underwriting. So helping do loans better, more efficiently using AI, that's a big opportunity within fintech.
Cameron, always great to see you. Get your thoughts. Appreciate it.
Thank you.
Thank you. Stick around. Much more Ask for a Trend right on the other side. U.S. stocks largely lower after hotter than expected January inflation reading. Here with the trading day takeaways is Yahoo Finance's Josh Schaefer.
Josh, we got to start with that January CPI report because it came in hotter than pretty much everyone expected. So it was hotter across the board. What I want to take a look at here is sort of the trend that we're seeing in inflation. So of course, our 2% target hanging out here in the orange. We're still well above that, of course, right? But also looking at the blue line here, year over year inflation, CPI coming in at 3.3%. That's a move up from where it was in December. Also a move up from where economists had expected. Economists actually thought it would fall. And then you look at the two trend lines I put in here with the white and the green, sort of your 3-month annualized, your 6-month annualized, the more recent trends. Those are heading significantly higher, Josh. And so the takeaway from this report essentially being, well, if we've been worried about the prospect of maybe higher inflation later this year, or once Trump tariffs come into play, some of those other factors people have been watching, there might be a little bit of an inflation issue for the Fed just right now with how the data is going. So I was surprised actually to not see the market sell off as much as it looked like it was going to this morning, but clearly all eyes were on this print, and there wasn't a lot of great takeaways from it to move forward.
So that was CPI. What about PPI tomorrow?
Yeah, so tomorrow we'll get the producer price index. Economists right now expecting that wholesale inflation actually also increased in January. And so the key reason, Josh, that we're talking about PPI tomorrow morning is once we get PPI, we get CPI. Fed Chair Powell was talking about this today. That gives you a pretty accurate reading of PCE. A lot of acronyms today, but that's the Fed's preferred inflation reading. So by about 9 a.m. tomorrow, we should have a good read on how economists feel about the Fed's preferred inflation reading for January, which will come later this month. But overall, it seems like more signs of sticky inflation probably expected tomorrow morning, probably expected for our inflation readings later in the month, which is why we get to takeaway 2. Takeaway 2, markets pricing in just one Fed rate cut for the first time this year. So what we're looking at here is different forecasts of where the Fed was headed. Green was back in December. You can see we've just sort of been ticking up, right? So this white dotted line now, that's only projecting the Fed moves once this year. Entering today, before this print, the debate had sort of been, maybe May, maybe June, then maybe they go once more. Right now, it seems like economists taking today's reading and saying, I think maybe the Fed cuts once if they cut it all this year, Josh.
What's interesting is there were economists and strategists, including someone on our show today, who was saying they thought the Fed is done cutting in 2025. It's done cutting. If that was true, Josh, what do strategists say? Okay, if that was true, what would be the knock-on effects? What would it mean for the stock market?
Yeah, so right now, I think the key thing is that markets still feel like the Fed is either not cutting or leaning toward cutting, right? Once we feel like markets feel like the Fed is leaning toward hiking, then you might have a little bit more of a market sell-off than we saw today. But I'll point out one thing. You were just referencing what Michael Kantrowitz was telling you, right, about the fact the Fed might not cut this year, but he still seemed relatively sanguine on stocks, right? He said maybe we get single-digit returns, which isn't bad. It's not negative, right? But what was Michael talking about when he told us that? He's talking about the 10-year Treasury yield, right? So we're at 4.6% now. You can see we've moved up pretty heavily in recent weeks, but notably we're still well below 5. And we're still below 4.75. So I think this is going to be the key thing to watch. If these readings continue to come in hot, we continue to price out rate cuts, maybe we move to rate hikes. If your 10-year moves closer to above 4.75, headed to 5, then you might be more worried about stocks. Right now, strategists largely say if you're in large cap companies, companies that aren't exposed to perhaps refinancing risks like some of those smaller cap companies, then maybe you're still in good shape. But overall, a more bifurcated return for the stock market as we sit with rates pushing higher.
All right, PPI tomorrow. Thank you, Joshua. Coming up, we are taking a closer look at the auto component of today's CPI print in our chart of the day. More asking for a trend on the other side.
a jam-packed hour focusing on the biggest movers and shakers on Wall Street.
This is market domination, and here, every day is game day.
We have 1 hour left until the market close.
It's game time for investors to make their final plays.
The clock is ticking, and we've got you covered with our quarter-by-quarter playbook.
We're bringing you in on all the market action,
with step-by-step analysis of our biggest trending tickers.
And expert insight into the day's biggest headlines.
We'll bring you the closing bell and get you to the finish line.
This is Market Domination.
Tune in daily from 3 to 4 p.m. Eastern.
For our chart of the day, we're focusing on the auto segment of today's Consumer Price Index and Yahoo Finance's Julie Hyman. Join me now with a closer look. Julie.
Yeah, this has been an area of focus, not just used and new vehicle prices, but sort of the other stuff that goes into all of the costs for a vehicle. And it's also one of the areas that could be the most exposed to tariffs, both directly and indirectly. So let's go through it here. I want to point out what we've seen in auto insurance first. That's the white line here. And even though it is slowing, it is still one of the year-over-year biggest components within CPI, seeing a gain of nearly 12% on a year-over-year basis for the month of January. Then you have auto maintenance and repair. That's the green line here. Now, again, that's trended lower, but then we saw a little bit of an uptick happening at the end of last year. And maintenance and repair year over year in January was up by nearly 6%. You've got all items in blue, but then going down to auto parts and equipment, that kind of trending a little bit lower and on a relative basis was up much less, about 1.4% year over year. Compare that with the cost to purchase a new vehicle, which fell slightly in January year over year. Used vehicle prices ticking up about 1%. So looking at all of this as a feed into inflation, of course, this has proven, especially the insurance piece, a little bit one of the stickier parts, even as it has trended lower. And again, considering that, not just talking about entire vehicles, but things like parts that are imported, or even if the materials used to make the parts are imported, all of this could potentially see an effect, not just from the proposed tariffs on Canada and Mexico, which have been delayed, but also those 25% tariffs on aluminum and steel. So something that definitely bears watching, Josh.
Is this when economists kind of break this all down, Julie, and they think about the direction of this moving forward, what do they say? What are their forecasts for these components?
Well, this is one of the areas that is less predictable because of the tariff trajectory. So we've been talking to a lot of economists who've been saying this is a difficult area to know. Now, if you assume, we talked to Jose Torres of Interactive Brokers earlier, and he said if you assume at least part of the tariffs are being used as a negotiating tactic, well, then you're perhaps a little bit more optimistic on some of these costs. If you, however, view it not as a negotiating tactic, but as something that is more of an economic tool, then maybe it's going to be a little bit stickier. And by the way, when you're talking about all of this, something else we have to include in it is the cost of labor to produce these things and to do things like auto repair. And we know there may be knock-on effects from the immigration crackdown across a host of industries. This could be one of those that also sees some kind of effect, but again, difficult to predict.
Julie, thank you. Appreciate it. As auto insurance prices rise and the threat of Trump's tariffs hang overhead, we're taking a closer look at what this means for drivers with Bloomberg Intelligence senior analyst Matt Palazzola. Matt, great to see you in studio.
Thanks.
Let's get right to this data. So CPI data shows vehicle insurance, Matt, I want to get this right, jumped 2% in January and has soared, economists pointing out, at double-digit rates since September 2022. What is driving that, Matt?
Yeah, so what happened, Josh, was in COVID, you saw automakers, auto parts makers actually cut their orders of like semiconductors and things like that. So it really disrupted the supply chain for auto parts. Okay, so auto parts got a lot more expensive. During COVID, a lot of people stopped driving, so auto prices actually went down a little bit, auto insurance prices. So these companies tried to gain market share, they lowered prices. Then what happened is parts spiked up, So the average cost of an accident went a lot higher. A lot of these companies got caught flat-footed, so they had to raise prices dramatically to catch up with it. So that's what you're seeing. And actually, you're seeing that kind of tail off now. So the rise in parts prices has kind of tailed off. So the profitability of auto insurers has come back. So you're actually seeing the price increases kind of decrease in frequency.
I've also read, Matt, that people are getting in more car accidents, and that's a variable. Is that accurate?
So I would say what has happened is safety in cars has actually decreased accidents, right? What happened during COVID was there were higher accidents, higher severity of accidents. So people were getting in faster accidents. The price of the materials, as we were talking about, got a lot higher. So the frequency actually has gone down a little bit, but the severity of the accidents went up, which means the cost to auto insurance companies goes up.
What about tariffs, Matt? Possible tariffs. What are possible ripple effects for vehicle insurance?
So we did some ground up and some kind of top down looks at this, what this would mean for auto insurance.
And it has to be tough to model, Matt, because duration, level of tariffs, right?
Oh, for sure. I mean, so the numbers we came up with, very rough.
Right.
But we said about a 15% earnings hit to some of the big public insurance companies that specialize in auto insurance. We looked at about, 55% of imported auto parts come from Mexico and Canada. Then the parts come in and out, cars go. So, we did our best to assume, how much of repair costs would be impacted. We did that. We said about half of the losses come from the damage to the cars. Half of those losses then are parts versus labor, and then we tried to look at the pieces of those that were impacted by the tariffs. And all that netted out to about 15% earnings downside should we see those tariffs for an entire year.
Were there certain companies that were better positioned than others?
Yeah, so Allstate and Progressive are the two companies with the biggest exposure to auto insurance, so the two biggest public companies with exposure. Others have it, but not as a big percent of their business mix. Out of the two of those, we think Allstate's better. We think Progressive's better positioned. They have dealt with this environment better than all the other companies. They're kind of more adroit in their pricing. Their profitability came back sooner than other ones. They're gaining market share. So we think even in a troubled environment, they're probably the one that would navigate it better.
Let me ask you this: the average annual premium for full auto insurance in the U.S. What is it now, Matt? What do you see it 12 months from now?
So I don't have an exact number because it's very different state by state. It went up. I mean, you're probably looking at 12 months, you're probably looking at over $1,000, just kind of nationwide, maybe 1,200, something like that. I think what is going to happen, should these tariffs not come into effect, you're probably going to see some price competition, probably in the second half of 2025. What these companies typically do is compete away excess profits, and they are in that position actually right now. Their underwriting is better than it was before COVID because of those price increases we talked about. They cut a lot of advertising, and that is now coming back. So I think you're going to see the price competition come back in the second half of the year. So don't kill me in the comments, but I do think you may see auto insurance come down a little bit in the second half of this year.
That's good news. I've always wondered this, Matt. Does everybody pay the same? Like if I'm next to my neighbor and we have the same vehicle type, let's say we have roughly the same driving record, we're both good, we're responsible, we're not texting while we drive. Is it basically the same or no, other variables come into play too?
Glad you're not texting while you drive.
Yeah.
Yes, generally yes. What is coming into play is something called telematics, right? So companies are trying to get you to use either an app on your phone or something you plug into your car, and that will determine a couple of things about how you drive. Should you have that, you and your neighbor, even if you are the same demographic, same car, same everything, your rates could be dramatically different. So the old way of pricing has generally been, let's look at all these demographics of the person, of the car, et cetera. The newer way of doing it is, let's look at actually how they drive, this driving data. And not a lot of policies are on that. Some startup companies, all of their policies are like that. But with these big legacy companies, you're talking about maybe 10, 15% are on the telematics kind of pricing basis. But should it be that way, that is kind of the best way for you, and it's the best way for the insurance companies.
Super interesting conversation, impacts a lot of people. Matt, thanks for joining us. Appreciate it. Let's take a look at what's trending here after hours. First up, take a look at MGM Resorts International. Those shares are moving higher after the company reported a beat on net revenue and adjusted EPS. MGM saying it expects to be profitable in 2025, pointing to December being its highest convention booking month on record and a revenue growth in its Vegas Strip resorts in January. Next up, HubSpot. That stock is moving lower after hours thanks to Q1 earnings and revenue forecasts coming in below street estimates. The marketing software company did deliver a Q4 beat on both adjusted EPS and revenue as subscription revenue grew 21% year over year. And Fastly shares sinking following a surprise loss in the fourth quarter. The company's outlook also disappointing Wall Street. Fastly forecasting a loss of 9 to 15 cents per share for the full year, while analysts were looking for earnings of 3 cents per share. That's a wrap on today's Ask for a Trend. Be sure to come back tomorrow at 4:30 p.m. Eastern for all of the latest market moving stories affecting your wallet. Have a great night.